you think the bond market might be overreacting a little bit to inflation? In regards to inflation expectations, the Federal Reserve doesn't seem very concerned at all. In fact, Jerome Powell has made another statement at the same testimony saying that he doesn't see he sees inflation spiking up, but he doesn't see it as a persistent long-term force. What do you make of that statement?
So Chair Powell is referring to what economists call base effects. By the time we got to May of 2020, in the heat of the shutdown, when demand had just been demolished, we saw the CPI print on a year-over-year basis at 0.1%. That was an annual level. So if we get, starting in March, April, and May, normal prints, we're going to see that CPI print well north of the 2% Federal Reserve target. What Powell's not taking into consideration, however, is the fact that input costs for manufacturers, for anything that's made, they're at the highest level in 12 years. Freight costs, shipping costs, they're at nosebleed levels. They're being passed along. At some point, you're going to have to try and see if you've got the pricing power as a manufacturer, as a seller of goods, to pass that along to the consumer. And oh, by the way, Texas, on a standalone basis, is the 9th largest economy in the world. And you just had it shut down. And a lot of it has to be repaired. Things like copper, steel, and lumber that are already, as I said, at well north of 12-year highs. So there's going to be a sustained period of support for a lot of the underpinnings of inflation that will not be as transitory as Chair Powell is expecting. And I think that is what the bond market, along with giving people money that they don't need to spend, I think the bond market is starting to sniff out the potential for inflation to be a little bit longer than transitory.
Okay, so the bond market was reflecting on higher inflation expectations. That's why yields moved up to, I'm looking at the latest 10-year, 1.5%, which is the highest it's been since early 2020.
It is. Much more importantly, though, is the rapidity with which we've seen the increase. In August, we had a 10-year yield that was a third of what you just said, 1.5%. So it's a very rapid move, and you have to consider that even though rates are at very low absolute levels, the rate of change, the delta, that matters as well. A tripling in the 10-year yield.
Right. So do you digest that as good news then, or bad news? Usually when, as we observe, the yield curve has also steepened quite dramatically in the last couple of months as well. Usually economists read a steepening of the yield curve, especially from near zero positions, as an improvement in the economy. That's why they're steepening.
And that certainly is the case that we want to see. But what we're seeing in markets and some of the jittery reactions we're seeing in stocks not liking the rise in rates is also an acknowledgement of the fact that we have more leverage in the system than we ever had before. So there are major refinancing needs with commercial real estate in 2021. The same goes for the corporate bond market. You have to be able to roll a lot of these bonds over, roll a lot of these loans over. And if you don't have record low interest rates and long-term rates have backed up, it becomes a different proposition. So you're also seeing nervousness about how over-levered the U.S. economy is and how it's going to handle these higher rates.
Yeah. Okay. So let's talk about the Fed reaction then. I've spoken to some analysts before, and one of the comments I've gotten was that the Fed is likely going to intervene. At least the FOMC is going to intervene because they do not want yields to tick up anymore. Is that a correct assumption to make, Danielle?
Well, Chair Powell and others have spoken very favorably about the interest rate sensitive sectors of the economy, housing being the most obvious one. We've seen purchase applications for homes decline in 4 of the last 5 weeks. This is not what the Fed wants to see. And so you could expect at the next FOMC meeting to hear from the Fed to say, you know what, we're going to try and mitigate the damage at the long end. Call it yield curve control. Maybe they're going to go further out on the spectrum and try and buy longer term, extend the maturity of Fed holdings to bring those 10-year, 30-year rates down.
Okay, when you talk about yield curve control, what exactly is the mechanism behind that? What tools do they have to implement this control? Well,
it's a lot of the same mechanism as quantitative easing, if you will. They're just going to buy up enough debt until they get the yield where they want for it to be. They're going to cap that yield at a certain level. In the past, policymakers have spoken to going all the way out to the 2-year when they speak of yield curve control. And I think that that's why Wall Street distinguishes between yield curve control, which the Fed sees as being in shorter maturities, versus extended maturity, purchases of extended maturities to bring down the longer maturity yields that are so critical and what the market is reacting to right now. If you had to ask Wall Street right now, would you prefer yield curve control or for the Fed to extend maturities? They would definitely say extend those maturities.
Mm-hmm. I'm curious as to why a central bank would even be concerned about nominal yields in the first place, because if you take a look at their two mandates, full employment and inflation control, which of these are threatened by a longer or a rise in the longer end of the curve?
Well, it's the full employment is certainly the one that is the most vulnerable. Again, you have corporate America that absolutely has to keep its balance sheet rolling over. It's a Ponzi scheme of sorts. I'm not trying to use hyperbole here, but you have to be able to refinance the debt. You have to be able to maintain your balance sheet, and if you can't, you're going to be cutting costs. And cutting costs is a polite way of saying reducing headcount. So that will make it very problematic for the Fed.
Right. So what's next for the equities markets then, Danielle? I mean, like you said, the equities markets really doesn't like higher yields. So either the Fed does something to intervene, or we could potentially see equities correct. Is that fair to assume?
Well, I certainly think we've seen the beginning of that. Anytime you see an appreciable move up in yields in the beginning of the trading day, stocks just do not like it. And if you see those yields start to come down as the trading day progresses, then you'll see stocks back off their lowest levels. So there's definitely a hand-in-hand movement right now between the bond market and the equity market. The FOMC meeting is not for several weeks now, and that could be a mighty long time for the Fed to be in a position of not intervening.
Okay, so let's put all this together. Are you more risk on or risk off right now in your sentiment?
Just seeing how very nervous and skittish the markets are and how vulnerable they are to 1 basis point, 2 basis point move, I would say that I think right now you have to be very well hedged or a very nimble trader.
Yeah, it's not. When we're talking about rates, it's there's a distinction to be made between normalization and rate adjustment, which is what we're seeing right now. The Fed is not going to normalize rates for a very long time. Is that correct to assume?
That is, but that's at the very short end of the curve, where right now the Fed is battling something completely different, and that's the possibility, the risk that at the shortest end that they're going to go negative because there's so much demand for Treasury bills. So that's a whole different segment for a different day, but that's what the Fed controls. And the market is nervous that they're concerned the Fed's going to lose control of the long end of the curve, which again determines borrowing.